All right, so the banks, the Fed, crypto, geez, how much can happen in one week? I feel like the last 10 days has been an absolute marathon as we continue to see a lot of rollover impact into the marketplace. And of course, Bitcoin today pumping up close to 27. I don't know if it's actually hit it today, but we're going to dive into a little bit of that for you. We've got a special guest joining us today as well. So before we get started, let's get into it on our sponsor, and that is I Trust Capital. Make sure if you're looking at long-term holding and you want to look at an IRA strategy, this might be one of the places you want to check out. There's a couple of things they do. You can get into both crypto, but you can also do silver and gold, so precious metals. They have an IRA rollover program, so whether it's your 401k, your TSP, various types, most likely they've got a solution for you. Just check the link out down below. You will get a $100 funding reward if you just use our link, so it does help the channel out. Let's get into it today. I want to welcome to our show again is Mr. Darius Dale from, of course, 42 Macro. Great to have you back.
It's always a pleasure to be here, Paul. It's good to see you.
Yeah, it's fun. Fun to have you, I think, in the sense that we get a chance to kind of dice up different analysis and viewpoints. And that's really kind of what our show is about, is to try to give more education into the markets on understanding macro, on understanding these effects on the market. Darius, I want to jump to Lynn Alden's tweet. I want to start with that, and I'm going to zoom in on this just a little bit. It says numbers are in. Fed's balance sheet increased by 300 bill last week. I mean, and if you look at the repo spike, and you can kind of see the numbers here, when you look at this on the surface, this appears to be, all bank oriented in the sense of where we're going to deal with these kind of scenarios placing out into these both regional banks with Silicon Valley. Obviously, the Credit Suisse, not necessarily our problem, but it is could be a systemic problem globally. When you look at this, first of all, how do you take the current situation right now as the Fed starts to make a potential roll into another interest rate or possibly a flat point?
Yeah, great question. Great question. And I think this is the central, argument amongst market participants, both in the crypto space and also in the traditional financial markets as well. As it relates to the Fed's balance sheet, I actually put together a few charts for your viewers here, Paul, that can just
Great.
kind of highlight, some of these changes. And so what we're seeing here is the Fed's balance sheet has actually increased to Lynn's point. And by the way, she does excellent work. So for those of you who don't follow Lynn, definitely make sure you check out her work. We saw a $300 billion increase in the Fed's balance sheet. That's the highest number we've seen since going back to the COVID crisis. On a percentage basis, not very large relative to the financial crisis, but that seems to suggest that this thing could obviously go up a lot more. And
Sure.
what's really causing this increase in the Fed's balance sheet is this gigantic increase, $250 billion or so increase in bank reserves. Now, what's causing the bank reserves to reflate is not good, in my opinion. What's happening is banks are actually tapping the Fed's discount window. They're tapping the Fed's bank term funding program, and they're tapping FDI insurance lines in order to shore up their liquidity profiles amid deposit outflows. And so, I think a lot of investors in the crypto space are sort of seeing they're seeing a pretty significant increase in what we call 42 macro net liquidity, which is the Fed's balance sheet, which includes that $300 billion increase, minus a change in the Treasury General account, minus the reverse repo facility balance. That big increase in net liquidity is causing, obviously, the appropriate response in digital asset space, obviously the move Bitcoin pumping up to 27,000, et cetera. But ultimately, we're not so sure that this is a sustainable increase for a variety of reasons. And I'll shut up after this, which is number one, the Treasury General account balance, which has declined, basically got cut in half since the end of January, only has about 6 weeks of runway at the current pace till it gets to zero. So that'll be it. Number two, the TGA will have to get replenished after the debt ceiling, which could potentially be ugly from a political theater perspective.
Yep.
And so we know that this decrease in the Treasury General account is not going to be sustained. Number three, the decline in the reverse repo facility that we've seen, it's gone from 2.23 trillion last week to 2.07 trillion, is probably unlikely to be sustained, given that we're likely to see increased competition amongst small regional banks for deposits, small and medium-sized regional banks for deposits with the money markets. And ultimately, we're actually starting to see net liquidity start to decline week over week, which may suggest some banks, which just really did this as a precautionary measure, are actually starting to repay some of that debt to the Fed.
All right. So, in I think broader terms, when you look at our audience, we have a lot of, I think, very sophisticated traders, long-term investors, and business people that kind of look at this from an outlook from an economic indicator, because these are typically going to start to be early markers in things like how businesses are going to respond. I would say between now and last Saturday, which is really kind of the firestorm when it began, once Silicon Valley last Friday, we had that, pretty much a run on a bank. The number of people that were calling me and the number of business owners that I've talked to in the last, large percentage of my circle, all talking about potentially moving out of banks and into other instruments, and also moving out of regional banks. So if this is happening with my circle, it's got to be happening in other circles. So, and it's back to something you and I talk about, and that is just, mitigating risk. You've got to figure out where that risk is, but at the same time, you're looking at things that are happening within the Fed, what we may see next, here in a few weeks with the FOMC meeting, and how Powell may translate this into adjustment on interest rates. Here's my question. With what's happened so far, it appears that we've kind of just injected all this potential, safety net, and there's not a whole lot left there to inject if we had a real big crisis starting to roll. Much like Larry Fink mentioned, this rolling crisis that could be coming upon us. What happens if we do see additional failures, and how would the Fed respond to that?
Well, it's not what happens if we do see additional failures. What's likely to happen are additional failures. It's really what we need to be discussing is how are we as investors going to position for and respond to that. So let me take a step back and just sort of explain to the audience sort of the difference between quantitative tightening and what we're experiencing today, which is obviously they look the same if you just sort of nominally look at the Fed's balance sheet. But the difference between quantitative easing and obviously banks taking up discount window funding, et cetera, is that this money that the banks are borrowing from the Fed has to be paid back. It's encumbered. It's effectively sterilized in the sense from the perspective of the broader economy, i.e. banks aren't going to be taking this money, levering it up to buy assets, securitization products, lending it to businesses and consumers or consumers, et cetera, et cetera. They're going to have to pay the Fed back. So this inflection that we're seeing in central bank liquidity is temporary, only to the point that the Fed decides not to, or the banks decide not to roll over this funding. Now, Paul, you might ask yourself, well, why in the heck would the banks decide to roll over the funding?
Right.
The issue is, if they do roll over this funding, it's obviously an indication of a deepening financial crisis. And this brings me to my second point, and I think is the more important point, which is central banks create bank reserves. Commercial banks create real economy money that you and I use to start businesses, to pay for services and goods, et cetera, et cetera. If the reason the Fed's balance sheet is increasing is because it's commensurately, the balance sheet of the private sector is commensurately decreasing, then you're not actually creating new money. In fact, we may get to the point in this cycle, this crisis, where the money destruction on the private sector banking side is actually accelerating faster than the money creation, the bank reserve creation, with respect to the Fed. So that really concerns me for a variety of reasons as it relates to the economic outlook.
Yeah, and I think that's the point I'm getting at, is now we're talking about, real world impact versus what you see a lot of times where there's some P&L financial gymnastics that are being done a lot of times that plays into this. With that being the case, though, I guess the real risk here obviously is going to be the failures that we will see come into the system. I think Credit Suisse and what happens globally is also going to have some, tentacle connections here into the United States. Real question is whether or not we see a major start to struggle. Obviously, we saw the situation with Wells Fargo re-injecting capital, I think almost $10 billion coming into them. With this playing out, when you look at the landscape here, Darius, and you consider how Chair Powell might respond to this, because there's a lot of speculation going back and forth on, does he go with a zero, basically no rate hike, or a 25 basis? There's still actually an outside chance on a 50. Where do you think this lands right now with the FOMC meeting here versus what might happen in early May on the next one?
Yeah, so that's a great question. I mean, so in terms of next week, I think I think the ECB gave Chairman Powell enough political air cover to continue on the tightening drive. Let's not forget the unemployment rate in America is right around 50-year lows. We're compounding core PC, the Fed's preferred inflation metric, at more than 2x if you look at it on a 3-month annualized basis, more than 2x the Fed's target. Obviously, we continue to see nominal GDP well above trend. This is not an economy that requires interest rate cuts or the provision of unencumbered liquidity, like a la what we saw in 2020 or what we've seen in previous, sort of recessionary episodes. So the Fed is in a really difficult bind because on one hand, we can see just through I'm trying to find a word that's big enough to describe the scramble for collateral that we're seeing in the repo market.
Yeah.
I mean, you're
Yeah.
seeing a deepening of term premium. You're seeing a real narrowing of short-term interest rate spreads in a way that suggests there's this real funding stress. And that, you don't need me to tell you that there's funding stress, but I did put together a few charts that I did want to highlight for the audience that kind of indicates and quantifies some of this stress. And so what I put together are just a few yield curves across the Eurodollar market. And for those of your viewers who are not familiar, the Eurodollar market is a giant interest rate market where investors bet on, kind of where the Fed funds rate, where SOFR is going to be at various points in the future. And so a lot of times large fixed income investors, of which is the second largest asset class in the world, they use this to hedge their positions. Equity investors use this to hedge recession risk, et cetera. And so let's start with the yield curve between June and April of 2023. As recently as last week, we got up to a peak of 32 basis points wide, i.e. the investors in the Eurodollar market thought the Fed would hike rates by 32 basis points between June and April of 2023. That number is now minus 15. So we've gone from pricing and rate hikes to rate cuts. If you look at the spread between September and June of 2023, we've gone from plus 17 as of last week to minus 59. So the Eurodollar market is already now pulling forward rate cuts from next year into the third quarter of this year, which suggests that there is obviously something going on that may happen, and it may happen soon. And what concerns me most, Paul, is that when you look at the December through September curve, it's not as deep as the Q3 curve. So effectively, they're thinking something big is going to happen sooner rather than later in a way that doesn't just pull rate cuts out of 2024. It actually is continuing to add rate cuts into 2024. So that scares the hell out of me, Paul. I don't want to scare your audience, but this is real, man. There is something going on in the financial sector, whether it be a crisis of confidence, whether it be, the $600 billion in unrealized losses across bank balance sheets effectively needing to be socialized, and it's not going to get socialized until all hell breaks loose. And so that really concerns me as an investor here.
Well, and to the point, I think a lot of this was, this early indicator was Silicon Valley Bank, which kind of showed I think the temperament of the market and how quickly it responded. What surprised me was how the Biden administration responded. They responded in kind the way they needed to. At the same time, I'm not getting the temperament out of government officials, lawmakers, that I feel like they're setting up this potential here versus what you're seeing. When you really do follow the macro numbers, the painting is starting to, it's almost like a paint by numbers thing. You kind of start getting the picture pretty quickly as you kind of explained there with those charts. So with that being the case, the potential in the financial system, possibly, basically, in essence right now, so much unrealized losses, there's no way this extends out, at least for a long period of time. In other words, we can't kick the can down the road any further. And you look at this, and I want to reference this tweet right here because I think this also kind of comes into it. So it's the liquidity, and he's referencing here. This is an author of a fairly significant book on how debt is structured. But this chart was showing how stocks are rising in the midst of this banking crisis. Central banks again pumping billions of liquidity into the market. So it goes back to your point of there's something happening underlying here. So with this, and it's not just systemic here to the U.S. This seems to appear in more global market constructs. So with all that being the play, and obviously you're advising clients in your own portfolio, what are you saying right now? What is it that you've got to have a lot of people out there just shaking their heads, going, "What in the hell is going on here?"
Yeah, so I mean, we've been at 67% cash in the 42 macro portfolio construction all March, even before any of this started to happen. And I think that was a very prescient call. I mean, we don't make those decisions. We have a systematic portfolio construction process, but the portfolio construction process was correct to identify the rising probability of financial accidents, which is what always happens when you have a high conviction deflation
Yes.
regime, which is what our weather model has been signaling for quite some time. And so we're not saying we predicted SVB or this particular instance, but it was all over the tape. I mean, you could look at the inversion in short-term yield curves. You could look at the inversion in the euro-dollar curve. You could look at all the components of why this is happening in the first place, which is declining private sector money creation. We actually have M1 tracking down on a year-over-year basis, which almost never happens in the history of the time series. So there were bound to be financial accidents, and this is just how they're choosing to manifest themselves.
All right, so all of this, this was a TED Talk macro chart. He showed this. I was on with Ran over on Crypto Banter yesterday, and he showed, kind of this liquidity. It was very similar to, December, early January, which is when we saw liquidity spilling back into the market. We've had the guys over at Vailshires Capital talk about this, and then of course the correction. We saw a little bit of a dip on Bitcoin and some of the crypto markets. Now we see Bitcoin, pretty much getting one of its biggest advertising pumps, I think, in the history of Bitcoin is seeing since 2008, okay? Because you haven't seen these kinds of things, this kind of landscape evolving since really 2008 when you look at the failure trapezoid of all those banks just literally just crumbling in front of us. With that being the case, Darius, I mean, do you feel that risk assets are, and I say risk assets, crypto in general, but also maybe some other aspects into industry. Some people may be looking into gold more often here. What are some alternatives that could help kind of ease the pain for at least a very balanced portfolio?
Let me start by great question, and I'll get to that just in a second. Let me start just by addressing the move in Bitcoin because I think that's a really important topic this morning, given that we're seeing, it's appropriately
Right.
responding to these headlines about liquidity. I think this is exactly what Satoshi Nakamoto wanted, which is, hey, this banking thing that we call the global financial system does not work. It's bound for failure. It's eventually going to fail. Here's an alternative. Now, that makes a lot of sense in terms of the pump that we're seeing in Bitcoin. And I do believe structurally, longer term, it's the appropriate response for asset markets and market participants to make. What concerns me about the path is that we have not seen the wave of deflationary private sector money creation that could very much be ahead of us. And in fact, is according to the Eurodollar curve, is likely to happen in the next few months. Yeah. And so what concerns me is that although Bitcoin is responding appropriately to what is obviously a tacit pivot by the Fed, at the very minimum, it could be a big pivot by the Fed in the matter of a couple of months. But I'm concerned that if you buy it at today's price, you might have to ride it down a significant wave in order for it to find an ultimate bottom before, in order for asset markets to really find an ultimate bottom, because there's nothing more damaging to your longer term net worth than deflationary money out of the private sector. It's what happened when Lehman went bust. It's what happened in 1998 when long-term capital management went bust. It's what happened in the dot-com bubble. It could potentially be happening here. So I just want to make sure that, hey, look, although Bitcoin, Ethereum, all these things are going to be longer-term beneficiaries of the banking sector being nationalized and effectively socialized, I just don't think that now is the appropriate time, given where we might be in the process. Talk to me in 3 months.
Yeah, you said something very important right there, and that is nationalized banking systems. Now, when you start thinking about this, already we have seen this in other countries. The likelihood is we could be very well on the path here in the United States for that very issue. With that being the case, wouldn't you think that we're going to continue to see, and I'm looking at it from a groundswell approach of how Main Street is going to address this situation. Some, of course, will go and flight to what might be, I mean, if you look at JP Morgan and the increase in depositors coming into those accounts, I talked to a JP Morgan banker just yesterday, and they explained, said, listen, we can't take enough appointments right now. We've got that many customers coming into us from other banks. So it's clear that this is most likely going to cause major havoc here in the US. Do you not feel that people are just going to say, okay, listen, I'm just going to go with the long-term play here, which is what Bitcoiners kind of talk about anyway. hey, just it doesn't really matter if I buy it at 25 today or I buy it at 12 in 3 months. I'm holding this for 10 years, and that's what I'm looking at. Do you feel that that is a strategy that would continue to work? In your opinion, what would you say to an investor that looks at it that way versus going into other aspects of investments?
Yeah, I mean, look, there's two communities of investors with respect to digital assets, right? And there's one community that just says you buy at all price, at any price, and hold it forever. And quite frankly, I'm not sure why those people would even be watching our show. Just you don't need any risk management device if you're just going to suffer through all the volatility.
They use it as entertainment.
Yeah, I guess, yeah.
It's just entertainment.
Yeah, a couple of nerdy guys in glasses talking about numbers on a screen. I'm sure there's better entertainment than that. But for those who don't like losing money, there's a concept in finance that I think is very under discussed with respect to financial Twitter, crypto Twitter, et cetera. It's called volatility drag. And what it effectively means is that if you lose money in the very early innings of your investment cycle, you can wind up with the same average return as another investor, but the person with the same return who did not lose money at the beginning of that process winds up with way more money. And so to answer your question, fine, if you want to buy Bitcoin at any price and every price, that's not what I'm here to discuss. What I'm here to discuss are those investors who are thoughtfully and tactically increasing their exposure and decreasing their exposure to digital assets, of which we are certainly in that community dating back to November 2021, when we told everybody to sell their digital assets. We are amongst that community of investors that thinks, I wouldn't say timing is the appropriate word, but certainly trying to use the macro cycles to time, where we are in that broader investment cycle. And I don't think we're anywhere near the bottom of the risk asset investment cycle. There's a few steps in this process. I think we're celebrating step one, which is, hey, we finally got the Fed's attention. That's step one. Step two is this big enough? Is this bazooka big enough? And if step two is no, if the answer to step two is no, we're going to have to probe new lows in assets and try to figure out who's next on the list that we can offer up as a sacrifice to the Fed to get them to do even more pivoting. And if that's not big enough, then we have to offer up an even bigger institution at the Fed a few weeks or a few months from now to get them to do even more pivoting. I mean, I liken it to Bear Stearns ultimately leading its way to Lehman. If SVB and Signature was Bear Stearns, there's a Lehman ahead of us in a few months. And I'm not. I think it would be very imprudent as a CEO of a company to tell any investor that it's appropriate to buy risk assets today, knowing that there could potentially be a Lehman ahead of us.
All right, so I want to jump over to this tweet right here because this gets into more of the global perspective. This is China lowering the required reserve ratio for banks. This is going to free up liquidity in reference to its banking system. The question is a good sign because more liquidity and markets love that. Or does it signal, back to your point, the broader contagion risks that might be isolated? Now, if we start to see real trouble in China, and the effect that obviously would have in the Eurozone, and also I would think cascading effects here in the United States, is it possible that an international bank could cause additional distress here within our own markets, especially at the scale of what China could be facing?
Not China specifically. They're not tethered to the global financial system vis-a-vis, derivative contracts, interest rates, swaps, and things of that nature, FX swaps. That's the scary stuff. That's why Credit Suisse is a big deal, because they are, very much at the center of that chain of derivative exposure, OTC derivative exposure. China's signaling. What China signals to me is that the ramifications of the drying up, of the destruction of private sector money that's happening in the U.S. economy is already being felt by other, our trading partners across the world. And that to me is concerning. Now, again, when you think about liquidity, it's not just what the central bank is doing. Obviously, if the central bank is expanding its balance sheet in a material way, in an unencumbered way, i.e. QE, as opposed to bank discount window funding, that's positive. But what is you have to get our hands on, and I'm not sure that anybody has statistics or idea because it's such a quickly moving beast. We have to get our hands around what's happening with private sector money creation. Is private sector money going to be deeply negative? Because that's the other side of the liquidity cycle narrative, right? China cutting PBOC, Fed discount window uptake, that's all good. It's better than nothing. I completely agree. Stocks should be up, Bitcoin should be up, but is it enough to fix the problem? And I don't think we're far enough along in this process. And I do emphasize the word process to understand whether or not this is enough to fix the problem. And I don't think
So
it
your
is, to be quite honest.
yeah, so your theory is Powell comes with another hike, most likely at 25, or do you feel like the 50 might come in?
No, I think he says 25. He talks up, hey, look, we have all the tools it takes to deal with this and da 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 da. And I
Yeah,
don't think markets are going to like it. And the reason the markets aren't going to like it is because what they actually want and what would send Bitcoin back to 69,000 and beyond, in my opinion, would be, look, we're done with hiking. We see a wave of deflationary money upon us. By the time we're done having this conversation in 3 or 4 weeks, I'm air quoting Powell
yeah,
here. By the time we're
yeah.
having this conversation in a few months, then it'll be very clear that deflation's on the tape. We've achieved our inflation mandate. Unemployment is rising. It's time to actually supply the market with rate cuts and QE. That is probably what markets need. The problem is with unemployment at a 50-year low, inflation compounding at 2x the Fed's rate, price stability mandate, and nominal GDP still growing above trend, they can't say that. But we
Yeah.
as investors can anticipate that, and more importantly, do things in financial markets that force their hand on that. And the things that we do in financial markets to force their hand on that are deeper inversions in the Eurodollar curve, significant declines in risk asset prices, stocks, crypto among them, and obviously, uninversion of treasury curves, looking at twos, tens, for example, to signal things like a recession is a very near term probability. That to me is what the summer of 2023 could look like. And
Yeah.
so, that's what I'm trying to sound that alarm bell, which is, yes, we're starting to get a little bit of that liquidity response, but it might not be big enough. The big liquidity response could be ahead of us after we have to go through the soup first.
Yeah, yeah, and I'm in agreement because this is something we've talked about here on the show quite a bit in the last few weeks. Is that I just feel like there is an undercurrent right now. We can't necessarily identify it, but we're starting to see the tones of what are the markers that cause these undercurrents to essentially become tsunamis. And it is one that I'm concerned with. I was looking at Charlie Bilello's tweet here, and this is an interesting strategy, in the sense of a bunch of banks came together and said, hey, listen, we're going to put 30 billion in First Republic. So you got banks helping banks within this. When you look at to me, when I look at the amount of things that are being thrown at the market right now, liquidity, the scenarios of what we're seeing within the EU, structures around what's happening over at Credit Suisse. Obviously, Silicon Valley gets its full depositors back, but the investors get smoked. I mean, you've got stuff coming at us from all ends here, and now you've got dogs and cats living together, which are banks helping banks.
Yeah, well, no,
kind of
that's
thing.
what should happen, right? Like there's $3.2 trillion, or there was three prior to the most recent increase. Now it's $3.25 trillion of bank reserves in the system. So in theory, the banking system is adequately capitalized as an aggregate unit. The issue is that there are sectors of the banking system that are overcapitalized, and then there are sectors that are growing,
Right.
apparently a growing sector that's undercapitalized. And that undercapitalization is an issue, obviously, for the real economy, because banks who are now in dire need of capital, either through the Fed's discount window or raising equity or some other reason, aren't going to be extending credit to their customers, to their, the people who borrow from those banks at the same degree. So that's an issue for the economy, and may cause the economy have a jump condition down in the
Yeah.
very near term. So be looking for that in PMIs, et cetera, for the month of March. When we get those in a few weeks, we could have a significant jump condition down into what could potentially be a recession if this really starts to snowball.
Yeah, this is the thing I am concerned about. We had kind of been looking at mid-year as being kind of this no-fly zone of potentially happening. It appears that we could be seeing that around mid-year into summer months. Again, not knowing the kind of damage that the market may take. Obviously, we'll see what happens in May with Powell on his next trip up to the FOMC podium, which will be intriguing in the essence of, will this be the pivot point that some people are looking for? Is there going to be enough damage in the marketplace for that period of time? Darius, I mean, you of course are studying this constantly. And by the way, if you guys are not following Darius, make sure and hit him up on Twitter, 42 Macro, but also visit his website because he's got an amazing service there that you guys need to check out. If you're in looking at high net worth individuals, looking at investment strategies, this is one of the guys that you want to see. I want to get your opinion on one last thing. When you look at the market as it is right now, and I want to now take 23 and kind of set it over here on the side because I feel like this is going to be a rough one. Let's take a look at 24 quickly and just assume that we've gotten past whatever this potential bombshell is that's going to hit us. and we've been able to print our way out of it, and we're moving our way back into 24. How do you feel the market is going to feel in the essence of aftermath? Because it took, if you think about 2008, it took a long time for us to see a real recovery, both from the business entities of the U.S. as well as the investment community.
Oh, so that's a great, phenomenal question, by the way. And I don't want to belabor this answer, but one of the reasons that it took the world a long time post GFC to feel better, I would argue probably took to 2013 for the economy to feel like it was back, really. Certainly it felt that way in my review of the media at the time, is because we had a legitimate issue with private sector credit. There was too much private sector credit. Nobody wanted to hold those assets. We knew they weren't money good. And ultimately there was a long default cycle, and the tail of the default cycle, i.e. tighter lending standards, persisted with us for many years after the GFC. That's not the case here. And on one hand, that's positive as it relates to 2024. And
right.
Quite frankly, I fully expect to be a raging bull in 2024. We'll probably be shorting every treasury bond in sight in that moment as well, including the US dollar as well. But I think there are some steps to get there there's some steps to take before we get there. One, the markets have to figure out, the markets are basically the conduit that speak from investors to the Federal Reserve. And the markets need to tell the Fed, not only do you need to back off, but you need to actually supply the market supply the financial sector with enough capital so that we can get rid of this hole. We need to socialize those losses for us to all be able to comfortably move forward. And once we're able to do that, I think things will be just fine. But the problem with going from fully employed economy, inflation compounding at more than 2x the Fed's price stability mandate, to the Fed supplying open-ended QE, not discount window financing, which needs to be paid back, but open-ended QE and rate cuts, there is a process of us market participants having to speak to the Fed to get what we actually want. And to me, that's the scary part about this, which is it could be very sharp, it could be very sudden. And once it's sharp and once it's sudden, that obviously causes a sharp, sudden, potentially very deep, nasty recession. But it could also be a very sharp, sudden recovery as well, heading into 2024, or maybe in the first half of 2024. So, we're not structural bears. I think we're probably going to see some really low lows. We revised down our S&P 500 price target to 28.45 this morning. 28.45. Could we be there by sometime in Q3 or Q4 of this year? If this gets ugly, absolutely. But I think you buy there because, again, ultimately we're going to get what we want from the Fed. It just may take a couple of innings and a couple of iterations of this back and forth process of trying to figure out where the counterparty risk is, who has what on what balance sheet, and so on and so forth.
Yeah, this is the thing. We've been talking about since last year, really kind of flowing into what and if that recession truly does happen. Obviously, the bank scenario was one of the key cornerstone elements that usually is of all these economic restructures, usually plays a big part, and obviously it has as well. Hey, I want to get to a poll real quick and see what our audience had to say about some of this today. Will there be another bank failure announcement before the end of the week? This is everybody saying yes. So 61%. I think it, maybe a little too hot right now, but again, you just never know.
No, I mean, look, the move we're seeing in the Fed balance sheet suggests that banks who needed the money in emergency terms are getting the money. The issue is the underlying problem of $600 billion plus of unrealized losses on bank balance sheets, which from an accounting standpoint is not an issue, but from a market psychology standpoint is now a very serious issue. And what it ultimately means is, hey, we force banks to take down by removing the SLR. We did something in 2013. We changed the liquidity ratios back in, say, 2013 or 2014. We did a bunch of stuff that basically forced commercial banks to hold all these securities, not the least of which is cutting interest rates to zero and keeping it there. And now someone's got to pay the piper, right? And ultimately what we're trying to the markets are effectively saying is, government, you put this money on the commercial bank balance sheets. The reality is it needs to be monetized on the Fed's balance sheet. And there's going to be a process for that to occur.
Darius, always fun having you on. I love getting the macro from, of course, 42 Macros. So thanks again for stopping in today. We appreciate it.
Paul, we appreciate you, brother. Thank you so much. And I appreciate your audience. You guys be good.
You bet. All right. So you guys, we're getting ready to go with another live here. So stick around. Hang out. We've got James from Invest Answers coming on. We're going to be talking about his opinion on maybe doubling down on crypto or taking a longer look at broader market participation in other assets. We'll take a look and dive in deep to that. I think we're going to be going live around 1 p.m. Eastern time. So we've already got the thumb up. If you guys want to hit your notification, make sure and jump into that. If you guys are not part of our Diamond Circle right now, get in. This is one of the best places, I think, that helps you guys stay part of a community. Of course, we offer some additional alpha over there in terms of podcasts and more content that doesn't come out here on the YouTube channel. So make sure and join there. If you want to hit me up on Twitter, it is out there at Paul Barron. We'll catch you next time right here on TechPath.